Now to the accounting portion of the program. This chapter is all about the accounting for what they call post-retirement benefits. It's mostly about pensions. All right. So the nature of pension plans, how they work, for most of you, you kind of have a handle on this, but for those of you who are totally unfamiliar and what I mean by a pension or any post-retirement plan, what the employer does is they'll make contributions on behalf of their employees to a fund. All right, and this is called funding the plan. So those contributions generally go to some sort of third-party financial institution, a bank or something like that. Here at UCF, I have some retirement that goes through Voya, which used to be like ING or something, and then now, and also I have Fidelity. Like they started with Voya, now they go through Fidelity. So Fidelity is the one that decides like where the stocks, where the money is going to be invested in the stock market, what types of funds. They make all those decisions, and then they handle the distributions during the retirement phase directly from that financial institution. So the employer kind of outsources that function and says, okay, we'll make the contributions, we'll set up this 401k or 403b plan, which is governed by rules that the IRS makes. But they'll give it all to the bank, and the bank will then therefore invest it and figure out the contributions, the benefit payments. So again, the assets and liabilities are held on the bank's balance sheet, okay? The employer doesn't hold those stocks and bonds and all those investments on their balance sheet. They just made some cash contributions. And so we're going to keep track of the pension plan in terms of whether it's in an overfunded, underfunded, asset liability, net status, but the actual assets are on the bank's balance sheet. Okay, and we'll talk more about that in the chapter. Okay, so there's two types of pension plans that we'll cover, the defined contribution and the defined benefit plans, which we'll explain in great detail in the next slide. The two questions that we'll talk about when we discuss each of these plans in terms of accounting is what is the pension liability or asset that the company needs to report on their financial statements, and what is the pension expense, that accrual-based number that's going to show up on our income statement under each of the plans. All right, so the first one is called a defined contribution plan. Defined contribution plan. So this is a situation where the employer says, I'm going to contribute X amount of my employee's salary into a fund every pay period. Okay, so I just made up 5%. So say the employer says, I'm going to take 5% of your paycheck and put it away for retirement purposes for you. Okay, in this situation, what is defined or predetermined is the contribution. What the future benefit will be is unknown. That depends on how the market performs, how the investments at the third-party financial institution makes, how those perform. The employer who's making the contributions is not on the hook. They have no promise to you that you're going to earn a certain amount during your retirement. They just say, hey, I'm putting this away for you now. What happens in the future, what happens in the future. It's not on me. So the risk is really borne by the employees, right? So as an employee, you know that this amount is going and being put away for you, but you need to kind of monitor it and see, okay, what kind of lifestyle do I want in retirement? Is this seem like it's going to be working out to be enough for me to live the lifestyle that I want and the amount that I want to spend in my retirement? The risk is on the employees. And the benefits are just based on whatever the plan value is at the age of, whatever you retire, 67, 70, whatever it may be. This is your typical 401k, all right, or 403b if you work for a state agency. So this is very commonplace right now in the market. Many employers are shifting to this type of plan. Most of you, the majority of you, if you go out and get a job, when you graduate here, it will be a 401k type plan, where that is considered defined contribution. Here, for accounting purposes, the pension expense is simply equal to whatever cash contribution the employer makes on the employee's behalf. Okay, so in terms of, from the employer's perspective, what they're going to write on their financial statements as pension expense is equal to whatever cash they contribute for that year, annually. The liability will show up if the full contribution that they intended to make, that 5% of their employee's salary, if they were unable to make it, for whatever reason, they're having an economic downturn, they're having some trouble, they don't have the cash on hand, they were unable to make it, then it will show up as a liability until they make up that full contribution they were on the hook to contribute. Excuse me, and then it will show up on an asset if a company happens to make more contributions than they were required. Maybe they're having a particularly excellent quarter or year, and they want to kind of give themselves a buffer and build up on the asset side for their pension plan. Okay, so in terms of the defined contribution plan, this is all we will discuss about those because they're extremely straightforward. The accounting is easy and they're not very complex. The complexities come in when we talk about the defined benefit plans. Okay, the defined benefit plans are where the employer says, I'll contribute X percent, I will promise you during retirement X% of your salary. Okay, so defined contribution, I promise to contribute X percentage of your salary while you're working for me through the years. Defined benefit is, I promise that when you're retired after working for me for X number, certain number of years, that I will give you this percentage of your salary, 75%. Or usually it's based on a formula. Years of service times a certain percentage of your highest paid years or something like that. Okay, so there's some sort of formula that defines what the benefit's going to be during retirement. Now, in this case, the benefit is determined by the plan. The employer contribution is going to vary. Okay, here it's the same every single pay period. It's an easy computation. It's just, we've decided that we're going to give 5%. You multiply 5% times your employee pay. On this side, however, the amount that the employer contributes is going to change from year to year. And how is that computed? It's going to be determined by nifty folks called actuaries. Okay, you might have heard of actuarial science or actuaries before. They're good with numbers. What they do is they generally assess risk, and they are really good at statistics. So in this case, in this scenario, in this context, what they will do is they'll take into consideration things like how long employees are working for us, when are they retiring, at what age are people dying, what's the mortality rate generally, what kind of turnover do we have, what's inflation look like. They'll take all these factors into account to figure out what is the obligation that you as an employer currently have in the future to all of your employees when they're retired. And based on that, how much do you need to contribute today in the current year to fulfill that future obligation? So in this class, we're not making those actuarial predictions or computations or anything like that. We're just going to say a lot throughout the chapter. The actuaries will tell us. The actuaries will tell us X, Y, Z. In this case, the actual amount that the employer is contributing annually under the defined contribution plan is going to be determined by the actuaries based on all these factors. The risk here is borne by the employer. Right? So here what could fluctuate was what the benefit is to the retiree in the future, right? We're not really sure what that benefit will be. Here the benefit is defined and clearly told to the employee, but the fluctuations can occur on the employer side on how much they need to contribute annually because the market fluctuates, economic downturns, those assets, those investments might not be as strong in some years as they are in other years. Okay. Here, this is what we consider a traditional type pension. Like if you hear your parents or grandparents ask about, oh, did they have a pension or I had a pension in this place? Those are generally the long-standing type industries like the auto industry, the airline industry, any industry where there's a major union presence, they're more likely to have these traditional type pensions. But a lot of companies, even those that have had traditional pensions that are defined benefit plans, are trying to shift away from those and get to more of a defined contribution plan. Tyler.
Is this something that the employee has to pay into, or is this like just a benefit like given to the employee saying when you retire?
Typically, a traditional pension is more like a benefit given to the employee. As part of the package of working here, we're going to pay into a pension for you, and we're going to guarantee you a salary during your retirement, right? Whereas on the 401k side, it's more we'll contribute a little bit, and then the employees are kind of voluntarily contributing a lot more to make up the difference.
Right.
Yeah. Yep. And the reason that it's really shifting more to this type of plan is because you don't have people that are loyal to one company and working for an airline or for an auto company for 30 years. You have people jumping around quite a bit from job to job, and so this is just, you don't need to really attract people as much with the traditional type pension. In this case, in terms of the accounting, pension expense does not equal to the cash contribution. It's a little bit more complicated because the contributions are changing constantly, and there's other components of pension expense that we'll talk about captured in that number. So as I mentioned, the next slides are going to focus purely on defined benefit plans. The defined contribution plan conversation really ends here, and you'll also see that true in the textbook. Okay, the discussion about defined contribution plans, it just kind of explains it, tells you how to figure out the expense and liability or an asset side, and then moves forward with defined benefit plans. So about 25% of the workforce still has these traditional pension plans, and 75% have the defined contribution plans. All right, so now we're going to get into some of the measurement of the liability, the assets, and the pension expense, okay, under these defined benefit plans. So how can we measure this huge obligation, this huge liability that an employer has to their future employees during retirement, for their current employees at a future time during their employees' retirement? All right, so one possibility is called the vested benefit obligations. This measures the benefits for vested employees only at their current salaries. Vested, we talked about vesting before when we talked about option compensation, but this means that the employees have the right to receive the benefits even if employment was terminated or ceases today. Okay, so one way to figure out what is our obligation is figure out who are our vested employees and what would we owe them in retirement based on what they're currently earning today. As if they didn't earn anything more in the future, how much would we owe them? That's called the vested benefit obligation. The obligation amount gets bigger when we jump to the accumulated benefit obligation, when we look at both our vested and non-vested employees at their current salaries. So, okay, we have just the vested here. Let's assume that also our non-vested employees are going to stick with us and get vested, and we're going to have to pay them in retirement as well. Let's get a little bit more of a conservative figure of what that obligation is going to be. That's called the accumulated benefit obligation, or the ABO. Then, to get even more conservative, we say, what are the benefits for our vested and non-vested employees at their future salaries, right? Because most people aren't going to be earning the same salary today in 20 years, right? Generally, salaries will go up from promotions and inflation adjustments and whatnot. So this is the most conservative. It's called the PBO, the projected benefit obligation, and this is what the FASB says companies should use when recording their pension obligation. Okay? Definitionally, thinking about it this way, it is the present value of expected cash flows that is computed by the actuaries. Okay? It is a present value computation. There's a present value component because we're recording the obligation or that liability today, and it's going to be fulfilled in a future year, right? So there is that time value of money component involved here. Okay, so what are the components of this liability of this obligation? The first is a service cost. Every year our employees have then worked for us an additional year. We've incurred more of a cost for our future retirement payouts, and so that's reflected as an increase to our obligation for every additional year that is worked. We also have interest on the liability. Again, getting back to this time value of money component. Similar to having bonds and computing interest over time, we're going to have an interest component on the liability that will also compute We'll talk about how that's computed later. We also have something that can increase the PBO, the pension obligation, called a prior service cost, okay? A prior service cost. These arise when there is an amendment to the plan, okay? A plan amendment. Well, what does that mean? The pension plan is defined in a certain way. For example, like I said in the example, you're going to get 75% of your salary at retirement. Well, maybe they change it to a higher percentage, 77% of your salary is what you're going to get at retirement. Or maybe they say instead of having to work here for 9 years to vest, we're changing it to only 8 years and then you're vesting. Usually it's an amendment to make it more favorable and more enticing for the employees. When that type of amendment happens, that costs the employer some money. They need to incur a cost to do that if they want to retroactively apply it to people who are already in the system. Right? So they have a group of employees working for them and they think they're going to get 75% of their pay after they work for 9 years, 75% 9 years. All of a sudden the board gets together and they say, okay, we're going to change the plan a little bit. We're now going to give 77% and you only have to work here for 8 years. Well, that change in the current year is going to give rise to new costs because we want to apply those changes retroactively to the group that's been working with us all these years, right? To not go back and give retroactive treatment and say, okay, you people who started with us, 5 years ago, you also get the 77% rate. If we didn't do that, it would really lower employee morale and get people really annoyed and pissed off, right? So they don't want to do that. So they apply it retroactively, but they incur a prior service cost to apply that change retroactively to their current employees. All right, so we'll talk about how to handle that, but when we have a plan amendment, it is generally going to increase the obligation. We also have other gains and losses on the PBO. These are generally arising due to changes in actuarial assumptions, okay? Changes in mortality rates or employee turnover, inflation rates, various things. We'll recognize any changes based on actuarial assumption shifts. We'll have to capture those in the obligation as well, because if we change one small component of the actuarial computation, it can shift what our future obligation might be. And the last component is benefits paid. As that third-party financial institution pays out the retirees, that reduces our liability, our overall obligation. Okay? So these are the 5 components of the liability side of the pension plan. It increases for every additional year our employees work for us, that's the service cost. It increases to capture interest on this liability because of the time value of money component. It increases if we make any sort of retroactive plan amendment. It may decrease or increase from a change in actuarial assumptions. And then it's reduced by any benefits we pay out because we're fulfilling our pension plan obligation. Okay, now we turn to the plan assets, the pension plan assets. Those increase as we make contributions. Annually, we'll make a certain number of cash contributions to the plan that's going to increase our pension plan assets. When benefits are paid, that is also going to reduce our plan assets, okay? Again, we'll talk about where this shows up in a company's balance sheet, because as I mentioned, the assets and the liabilities are actually on the third-party financial institution, but we like to show a net funded status in the employer's books. All right, so as contributions are made, it increases the value of our plan assets. Our benefits are paid. As benefits are paid, it reduces the plan assets. And if we have any sort of return on our plan assets, generally it's going to increase. Hopefully, when market conditions are good, it's going to increase the balance on our plan assets. These are things like interest that we receive, dividends that we receive, increase in the fair value of our plan assets. That's our actual return on our plan assets. The third thing that we're going to have to measure is the pension expense. And we're going to go through each of these 5 components on the next slide. So the heart and soul of the chapter truly is understanding these three items, okay? Understanding the components of the obligation, the liability side, and which things affect and influence the obligation. The components of the assets, okay? The liability side, the asset side in terms of the pension plan. And then the third component is how to compute pension expense and looking at these various components. That's really the guts of the chapter are those three things, and we're going to see that play out in many different ways and add different components, but or look at different contexts, but these are the main components. All right, so when we get into pension expense, I just wanted to make a note here that for the third one, this is the expected return on plan assets. We're going to have a large discussion at some point in the chapter about what the expected return is on the assets, so what the actuaries think is going to happen with our stocks and bonds that are invested, and then the actual return, what truly happened in real life. Those are two different things that obviously, if you've ever invested in the real world, aren't always the same, right? What's the expectation and what actually happens generally are not the same. We might be in a better position or a worse position than we expected. But in terms of computing pension expense, we're using the expected return on plan assets. All right, going through the 5 components, the first one is the service cost. We briefly discussed this. This is the present value of new benefits earned by employees during the period. Okay, 1 more year has gone by. We have 1 more year of service that we need to pay future retirement benefits for, so that increases our obligation and increases our pension expense. Interest, again, this is based on the time value of money component. The FASB doesn't give an exact method of computing this interest, so the standard practice has been to simply take the beginning balance in the liability, the PBO, take whatever the beginning balance is of that obligation and multiply it times a rate called the settlement rate. The settlement rate is provided to us by the actuaries, okay? They make an estimation of if we had to settle this liability today, what would be the rate at which we would have to settle it, and that's their definition of the settlement rate. So when we're doing our computations of pension expense and we want to figure out what's the interest on the liability, it's very straightforward. There's no schedule, there's no amortization. We just take the beginning balance in the PBO times the settlement rate. Okay, the third component is the return on plan assets. As I said, most of the time, hopefully our assets are getting bigger and bigger. So if the return is positive, we're going to subtract it from pension expense. It's actually going to lessen the amount of our burden in pension expense if we have a positive return. If we have a negative return, we lost money on our plan assets, we're going to add it to pension expense. Kind of works in the same direction as the idea of an expense, a sacrifice. So if we're doing well, the plan assets have a good return, we're going to reduce, lessen, subtract out our return from pension expense. But if we have a bad year, it's a loss, we're going to add it to pension expense. All right, the next is the amortization of the prior service costs. Now, when companies make these plan amendments that I talked about, I gave you some examples before, when they get together and say, we're going to make this change to our pension plan, the FASB said, okay, we don't want you to take this big $2 million hit in that single year of your plan amendment and say, okay, your pension expense is going up $2 million this year because you made this nice change to help your employees. We don't want to punish you for that. So what we're going to do is we're going to allow you to amortize that prior service cost over the periods of the employees that are going to benefit, okay? So companies should not recognize those retroactive benefits as pension expense in the year of the change. We don't recognize that big $2 million right away because that's going to reduce our net income, our earnings per share is going to go down, it's going to look bad to investors. So the FASB says, okay, we can avoid that. Instead, what we're going to have you do is record any PSC prior service cost, record any prior service cost to other comprehensive income as a loss initially, okay? If you guys remember about other comprehensive income, we have our revenues, we have our expenses, we have net income. That's how we compute EPS. That's a big important number. Below net income, we have some gains and losses that are actually flowing through something called other comprehensive income, because maybe they're not fully closed out yet, maybe they represent big volatility or fluctuations, and the regulators have allowed these gains and losses to be in other comprehensive income so as to not mess with net income for the time being. This is one of those examples where they say, okay, record this big cost to other comprehensive income as a loss, because it is a loss, a sacrifice you incurred to make this change. Then amortize it to pension expense over time. So you are recognizing this charge, this cost that you're making with the plan amendment, but not all at once. You're doing it little by little over the years, and you're reducing that other comprehensive income loss. Okay, so you put the big loss to other comprehensive income initially, then you record it to pension expense a little by little over time, and the other side of that entry is reducing the loss in OCI. We're going to do this many times and many examples. I'm just introducing it to you now. The amortization method, and then I just wanted to remind you, like if you think about in T-account terms, OCI, we're going to debit losses and credit gains. Kind of like debiting expenses and crediting revenues. For other comprehensive income, it's the same. When we have a loss, we will debit OCI. If we have any sort of gain or reduction of that loss, we will credit OCI. Amortization, the FASB prefers year of service method. So we'll take that total prior service cost, $2 million, whatever it is, and divide it by the average remaining service life of the employees at that time. Again, the actuaries will tell us, the average remaining service life is 17 years or 13 years this year. So we'll just take what that cost is and divide it by that number of years. All right, so that's how prior service costs work. And then we have some gains and losses that we'll talk about more, this component on Monday, okay? So for this fifth component of pension expense, we don't really get into it today, but we'll talk about it on Monday. It has to do with certain volatility from changes in the fair value of plan assets and changes in the PBO. So again, to summarize, pension expense goes up for every additional year the employees work for us, goes up for interest on the PBO. It's reduced when we have a positive return on our plan assets. It's increased if we're amortizing any sort of plan amendment or prior service costs. And it might increase or decrease from gain and loss effects, which we'll talk about on Monday. All right, so again, those three things, the heart and soul. Now, let's do an example, okay? I put all of this information here on the board, so we can refer back to it. But this is how these pension problems are going to work, and we're going to use something called a pension worksheet to try to understand how each of these components, the pension expense, OCI, the asset and the liability, are impacted by the activity happening within the pension plan throughout the year. Okay, so here's all the information. We're just, the return, the benefits paid, contributions made, the beginning balances of our plan assets and PBO. We did have some amortization of a prior service cost, our current year service cost, our balance in AOCI at the beginning of the year, and the settlement rate. Okay. So this is what the pension worksheet looks like. Okay, on the right-hand side, we have the memo record of what our obligation and the running total of our plan assets, the running total of both of these. It's a memo record, again, because the actual assets are housed in the financial institution. We just give cash, but they have the actual stocks and bonds that are invested. Okay, so let's just start at the top. January 1st, 2014, the beginning of the year balance in our pension plan. We start with a $166,000 credit. Where did they get that information? Well, you take the liability balance of $850K and compare that to the assets, our pension plan assets of $684. We net them together and we have a net liability of $166. Okay, so that takes care of the beginning balance in our assets and the beginning balance of our obligation. So that's how we'll always start, and we kind of lay it out in the memo column in that same fashion. The $850,000 credit, the liability balance, and then the $684 debit balance in our plan assets. Okay, Then we go through each component of pension expense, and we kind of stick to that same order that I introduced at the beginning of the chapter. Starting with number one, what are the service costs? Okay, the service costs listed in our information were $90,000. Service costs represent an increase in pension expense and an increase in our obligation over here. So for every line that we have in the worksheet, we're going to have debits equaling credits. Okay? So if we debit pension expense, we increase pension expense $90,000, the offsetting credit is going to be to the liability for $90,000. We're increasing the PBO for every additional year worked. Next is the interest costs. We're going to use that settlement rate of 10%, right? We multiply the 10% times the beginning balance of the PBO. The beginning balance is $850K, so the interest is $85,000. That's a debit or an increase to our pension expense. It's also a credit and an increase to our obligation. Okay, that's the second component of pension expense. The third component is a return. Okay, so here we have, in this example, we don't distinguish between what the actual and expected return is. We'll talk more about that on Monday. Here we assume it's the same thing. The actual and expected return is $60,000. We have a positive return that reduces our pension expense. In this case, it was $60,000, so it reduces our pension expense, which is a credit of $60,000, and the actual return is going to increase the carrying value or the balance in our plan assets. Okay, so for that third component of pension expense, the actual return reduces pension expense, increases plan assets. Okay, the third component is that amortization. We had some sort of plan amendment in a prior year, and we're slowly but surely taking that big loss. We don't know how much the loss was initially, but they hit some big loss, they put it in OCI, and slowly but surely over time, they're pulling it out of other comprehensive income, and they're putting it into pension expense. So the amount of that amortization for this year is $15,000. So we increase pension expense $15,000, and we back out that loss from the OC. Up here, there's a heading for OCI related to the prior service cost. So we're backing out that loss that we initially took by $5,000 in the current year. All right, that's the fourth component, and then we're not dealing with the fifth component, any gains or losses quite yet. But then we have the contributions made. So we contributed $105,000 to the pension plan this year. So that means that we literally wrote a check, paid cash money to the financial institution, right? So we reduce our cash, and then we increase our running our memo record over here of our plan assets. Okay, so when we cut that check, we're reducing cash, we're making a contribution, we reduce cash, and we increase the plan assets. And then the next component is when we paid out benefits. We paid our retirees $40,000. Now we're not going to reduce cash because the cash contributions were made back when they were working for us, right? The financial institution is going to write them a check and pay them cash. What we're simply going to do is show that our obligation has been lessened when we pay out benefits to our retirees, and our plan assets have also been reduced by an equal amount. All right, so completing out the worksheet, this yellow line here is going to be what our journal entry is from the employer perspective related to the pension plan. We add up all of our debits and credits in this column to get to what our pension expense debit is going to be. Here we just had one cash transaction, one transaction related to OCI. And then over here, this is actually going to be a plug. So we start with the $166,000 credit balance. The plug is to balance basically the journal entry. So the first thing we do is we figure out these components here if we have them. The pension expense, our cash contributions, and any OCI gain or loss adjustments. Okay, in this case, our pension expense was $130,000 debit. We reduced cash $105,000, and we reduced that loss on OCI by $15,000. So our plug in this journal entry is the $10,000, and it's on the credit side. we can check whether that $10,000 is correct because it's going to tie out. What do I mean by that? If we take the beginning pension asset net balance of 166,000 credit, and we add the $10,000 credit here, that was the plug in this journal entry, we come to this $176,000 credit, right? Now that should tie to this number here, the net ending balance in our plan liability and plan assets. And then the final thing here is they did give us a beginning balance of accumulated other comprehensive income of 160K. We adjusted it 15,000, so now the ending balance is 145. So the accumulation of our net income numbers, right, of our net income shows up in retained earnings. Right? We've talked about that time and time again in the class, that retained earnings is the accumulation of all of the net income of the companies throughout the year. Now, OCI also has the accumulation of that balance housed in accumulated other comprehensive income. So this is on the income statement and this is on the balance sheet. So on the income statement is net income. On the balance sheet is the accumulation of net income in an account called retained earnings. On the income statement we have OCI, and then the accumulation of OCI through all the years is housed in an account called AOCI, accumulated other comprehensive income, and that's in the balance sheet. Okay? So that's what they're showing here with the AOCI beginning balance of 160, and then we made an adjustment. We reduced it by 15,000, so the ending balance is now 145. So that is a pension worksheet. On the exam, you are not creating a pension worksheet. You're not filling out a pension worksheet, just like you're not creating a statement of cash flows on the exam, right? So instead, what I might do is give you all the components of pension expense and ask you, what was pension expense for the year? So you don't need to memorize the worksheet or, I don't know, even know how to do the worksheet, but you need to know what the components of pension expense are and which direction they move pension expense. Then I might ask you how a return on plan assets is going to affect our obligation or our assets. And then you need to know, okay, when we have a return, it's going to increase the carrying value of the balance in our plan assets. So where you don't need to know, per se, how to do a pension worksheet for the exam, it is a great big picture summary of all the little components and the concepts that you need to know for this chapter. It really summarizes, like I said from the beginning, what are the components of pension expense? What things adjusted up and down? What are the components of the obligation? And what are the components of the pension plan assets? So we kind of went through the definitions of those three things, and then the worksheet lays out really nicely the actual transactional movements within each of these accounts. And you can see how it nicely lays out what our ending journal entry should be. Okay, so, a little note a little tidbit. As of July 2018, the funded ratio is 93.4% for the largest 100 U.S. corporate defined benefit pension plans, which seems like super high. And I should probably look, it's in my notes where I got that from. But it was probably much different during the Great Recession, 2008, 2009, 2010 time when companies were having a very difficult time funding their pensions. And you don't need to know that for the exam or anything. It's just a little fun tidbit in case you're wondering, do companies mostly fund or underfund? They're mostly underfunded. As you can see, the ratio is 93.4%, but it's a lot higher than I expected, that they're to being 100% funded. All right, a few notes about the worksheet. The balance in that pension asset liability column should equal the net balance. So what I said in the end here, we can kind of tie this all out to see, does this balance here tie to the memo record balance of the net asset or liability? That should tie. For each transaction or event, debits have to equal credits. The balance of the PBO and plan assets, as I mentioned, are not reported in the company's balance sheet. Their memo entries are considered off balance sheet. If the plan assets are greater in value than the plan liability, the obligation, it's considered overfunded, a debit balance, a net debit balance, so we will see a pension asset appear on the balance sheet for that company's financial statements. If, however, the plan assets do not meet the obligation, they're less than the obligation, it's considered underfunded, a net credit balance, so we would see a pension liability show up on the financial statements of this company for the balance sheet. All right, so let's do example number 1. I'm just going to quickly write all the information up here on the board again. Yep. So for those of you who don't have the given information, oh, I forgot to bring a blank pension worksheet for you. I'm sorry. I meant to do that. Yeah, because it's kind of nice to have this like little setup, right? Like this. So you can just kind of write in each of the things. I apologize. It's kind of nice to just have it all laid out this way. But this is where we're going. So if you have like a blank piece of paper and you want to kind of like write through how we're computing all these, this is where we're going. This is what the worksheet's going to look like if you want to kind of take notes. These are the columns that we'll deal with. Okay. So PBO. So this is another problem where you're just kind of given all this information, and then we have to show where it appears on the worksheet. The rate is 9%. So this is not in my slides, just so you know. It's not in my slides, but I just do it this way because you can see the whole worksheet. 65. So I'm going to have you help me walk through this now that you're experts on pension worksheets. Okay. So let me increase the lighting if that's okay. Make sure everyone's awake. So this is all the information that's provided in your given information. So like the chapter 20 in-class exercise looks like this. The following defined pension plan data applies to the year 2012. So all the information I just wrote on the board, that is the given information in the first problem for the chapter. Okay, the beginning balances of the PBO and plan asset, the pension liability as of the end of the year. It's a net liability. They actually computed it for you what the net liability was. They tell us that at the beginning of 2012, the company makes a plan amendment and grants the prior service benefits, and that has a present value of $120K. So this is the example of a prior service cost that happens via a plan amendment. Settlement rate of 9%, current year service costs, some contributions, some return. Again, here we're showing the same actual and expected return. Benefits to retirees, and then the amortization. Okay, so let's go through and see if we're understanding where all this stuff is going to show up. And for this problem, the debits are not in parentheses and the credits are in parentheses. So you'll see it different ways. I think that Wiley uses this approach, but the approach that we used in the prior example just kind of wrote, you know, debit or credit next to it. But I just wanted to make sure that that was clear, that in this problem and in some of the Wiley problems, they show a credit as in parentheses and a debit not in parentheses. Okay. So let's go with the first line here. December 31st, 2011. What are we going to show here? Any guesses? All of our talkers aren't here. What are we going to do?
The PBO balance.
We're going to show the PBO balance of 560,000. That's correct. Under the PBO, right? What else are we going to show? The plan asset balance. Yep, those are both going to go on the top line. And then what is the third thing we're going to show?
Pension asset liability.
The net balance, right. So on the first line here, I know it's kind of hard to see, so I'll dim lights. I didn't want to dim them because it makes everyone sleepy. But that first line is going to show assets of 546, the obligation of 560. We net them together to get to the 13,800. Okay. So that takes care of the first three lines of given information. Okay. The next line, they've labeled PSC for prior service cost. Okay. And this relates to which number? Which number here?
Service cost.
The 120,000.
Amortization.
Well, it's going, no, this is the actual time that they made the plan amendment on January 1st, 2012. So we're going to first do the journal entry, or, you know, show in the pension worksheet what accounts are affected by this big plan amendment. OCI is one of them, right? Remember now there's two sides. So are we going to debit or are we going to credit OCI? So we have OCI, the T account. The debit side, the left-hand side, is going to be for any loss. And then the credit, or the right-hand side, is going to be for any gain. So in this case, where we made a plan amendment, are we debiting OCI or crediting OCI? Debiting OCI. All right, so when we make a plan amendment, we're incurring a big cost. The FASB says, don't put that big cost all in pension expense because that's going to make your pension expense fluctuate too much in 1 year. Instead, put it all in OCI so it subverts. It does not go through your official net income, right? We can get away from that completely. And you just house it in OCI and we'll amortize it through the years. Okay, so the debit part of the transaction goes to the OCI prior service cost. Where's the credit side? What does it do on the credit side? It doesn't affect the assets. The liability, the obligation, right. So when we have a plan amendment that we want to retroactively implement, that's a big cost to us. The FASB says, don't put that big cost all in pension expense. In the year that you make the change, take that big cost estimate, debit it, put it in other comprehensive income as a loss, and then it also increased your obligation because it increases what we owe to our employees in the future because we've made more favorable terms in our pension plan, right? So that's why it increases our future obligation. All right, so now we kind of do a line where we do a subtotal, figure out the new balance as of January 1st, 2012. We're going to use these balances when doing our future computations. So we kind of do a subtotal here. So now we've taken into account the prior service cost of 120K. Okay. All right, so if there's a prior service cost, there's a plan amendment, it flows through other comprehensive income and it increases our obligation. All right, Next is the line for service costs. The given information tells us that the service cost is $58,000. So which columns are impacted by service cost?
Pension expense.
Pension expense
Obligation.
and the obligation, right? So we're going to debit pension expense for $58,000, and we're going to credit, also increase the obligation for $58,000. Okay, so that takes care of the first component of pension expense, which is the current year service cost. Okay, the cost incurred for the current year's worth of service. All right, the second component is interest. Interest costs. How do we compute the interest costs? Do you remember?
56, 560 times
We take the settlement rate, which is the 9% that they provided, and multiply it times the beginning balance of the PBO. Since we had a plan amendment as of July 1st, the most accurate beginning balance is actually the 680,000. So we're going to use the 680,000 times the 9%, and that goes in the pension expense column, and what other column? We're going to show interest here as the second component of pension expense, and we'll also
Obligation.
in the obligation, right? So we're going to multiply the 9% times the beginning balance of the PBO, technically the beginning balance plus the immediate change we made to the plan as of January 1. Okay, that increases pension expense, and that increases our obligation or our liability. The next line is the return on our plan assets. Okay, so here we use the 9%. So the plan assets return, I guess is 52,280. Is that right? Yeah, I think it's 52,280. So where's that going to show up?
Pension expense.
As a debit or as a credit to pension expense? Credit, right? It's going to reduce pension expense, and then what's the other side of that? The plan assets, right? It's going to reduce, we have a return on our assets, so it reduces the amount of pension expense, but it increases, we want to show an increase to the value of our plan assets. Okay, so that is the return on plan assets component. Okay, so we have the first three components, and then the last one that we'll do so far in the chapter is the amortization. All right, so what the amortization of the prior service cost. So they tell us how much it's going to be, the 17,000, and where does that going to show up? Pension expense as an increase or decrease? So the idea with the prior service cost is don't put it all in pension expense in the first year. Don't increase your pension expense by, $2 million, $120,000. Wait until, put it all in OCI, and then little by little put it into pension expense instead of all at once. So we put the big amount of 120,000 in there, and then little by little we're going to amortize it into pension expense. So is it going to be a debit or credit? Debit. And then where is the offsetting credit going?
Obligation.
The OCI. It's going to other comprehensive income, right? So we initially book it here, but then we amortize it out of OCI and into pension expense. So when we make an amendment to our plan, when we incur a big cost to retroactively treat it, we're going to put it in OCI as a loss, and then over time, we're going to amortize it, remove the balance slowly but surely out of other comprehensive income and into pension expense. And instead of taking a big $120,000 hit this year, we're going to take a $17,000 hit every year for the next, whatever the math is, 10 years or so.
Is the OCI just PSC, that column right there?
Yes, in this problem. There are other things that can flow in and out of OCI. In this problem, it's only going to be from the prior service cost.
Okay.
Yep. All right, so that gets us through the amortization component. The next line that we have here is contributions made to the plan. We made contributions of 65,000. So what is that going to affect? Which column here? Cash, credit cash, and debit asset. That's right. We're going to reduce or credit our cash, so it's going to be shown here in parentheses, and we're going to increase our plan assets because we've handed over $65,000 to the third-party financial institution that's then going to invest in $65,000 worth of securities. And then we paid out some benefits. So our retirees got $40,000 worth of benefit. The financial institution paid it out, but we have to keep track of the benefits being paid. So what is that going to impact? The assets and the obligation, right? We're going to show that our obligation has been fulfilled to some extent, so we debit it for $40,000. We debit that liability, and we are reducing how much is sitting in our plan assets because some of it is being dispersed to our retirees. Okay, so we've done the big part. We've gone through each line-by-line transaction here. Each of the components of pension expense, we had a prior service cost. We amortized that prior service cost. We made some contributions. The retirees were paid. So we see how all of those transactions play out within the worksheet. Then we total them down to get to the journal entry. Our pension expense is going to be a debit of $83,920. Cash will be credited $65K. Prior service cost is going to show a net debit, right? A debit of 120 plus a credit of 17, so it's a net debit of 103. And the plug here is the 121. Debit, credit, debit, credit. So we're going to debit pension expense, credit cash, debit OCI, and then credit the pension asset liability. They didn't tell us about a beginning balance of AOCI or ending balance at the end of last year, so we assume that it's zero and that new balance is just going to roll forward. So if we total down the beginning net balance in our pension plan and add in this credit, so actually subtract it out even more, it's a credit at the beginning, and we credit it even more, we have a net credit position of 135. That should tie to this, right? Totaling down these two columns and finding out the net balance here on the memo record. And it does. Okay. So that is your beautiful pension worksheet. Come up with a journal entry here. This red component here, that's a plug. You can figure out if that's the correct number by adding down these numbers, getting the total ending balance in the pension asset liability account, and that should tie to the net balance in our memo record for our obligation and plan asset. Any questions so far about the wonderful world of pensions? All right, so the journal entry, I mean, it's just as I laid out in the previous slide, looks like this. And that is all I have. If you'd like to write down this journal entry, you can. It's also laid out here, at the bottom. But if you're more visual and need to see the indentations and debit and credit side, there it is.